you can't assume appreciation, and you can't assume that you're going to know what's coming up on these blind rankings. So
all right.
That's not an option.
I thought you'd come up with better options. So,
all right, we're here for another blind rankings. This is where Tim gets 5 things in a category and has to rank them without knowing what's coming next. This time it's risk versus reward blind rankings. So these are all things that you can invest in, and you have to determine if the risk is worth the reward. So we'll start with ground up development.
Are these all real estate?
Yes.
Things? Mm-hmm. So different asset. All right.
Yeah.
Ground up development would be 5.
5, all the way at the bottom.
5.
Wow. Without knowing what's coming next, ground up development is number 5.
I don't like it. The end product's awesome, but there's a lot of speculation and a lot of risk leading up to it. There's obviously land risk, there's property improvement risk, there's a financing risk because you can only get construction loans on it, and it's a short-term bridge type loan. There is construction risk of things going over timelines and over budget. There's then the refinance risk. There's a lease-up risk once it is occupied, a timeline risk. There's a lot of risks that go into new construction. And on the new construction projects that I've done, I found that the upside that I thought I was going to get by building it ourselves and taking on that responsibility ended up being far worse than just buying something stabilized right out of the gate.
Okay.
Just buying something that was already built, even if it was vacant, if it was already built and I could just lease it up and do it that way, like that would be better than building new construction.
Ground up development is in the basement on these blind rankings. The next one is heavy value add.
So that'd be like number 4. Heavy value add?
Heavy value add.
So here's the thing, at least it's already built. At least you already have COs for the most part. At least utilities are already in. At least you can get better financing. Maybe half of it's built or half of it's occupied over here and you're just renovating these buildings over here. You're adding stuff. That to me is a lot lower risk and has some upside. But you still have a bridge loan. You still have construction risk. You still have additional lease-up risk on all those units. I'll put it 3 though.
Okay, you're going to put it at 3. And just a reminder that risk versus reward. So we're taking into account that, yeah, you've got a lot of risk on the front end, but even if you overcome those risks, the reward necessarily isn't worth, the juice isn't worth the squeeze kind of thing.
Yeah, I mean, it's far more predictable than ground-up development because you know that you can have these online inside 12 months instead of 36 months, right?
Right.
And so you know that there's a lot more predictability in your comparables on rent comparables, and you have a better indication of what the financials are going to look like versus something that's 3 years out that hasn't been built yet. So you know what the reward's going to be. There's still some risk, but not as much risk as new construction.
Okay, so that's number 3, heavy value add. Our next on the list is turnkey rental.
Turnkey rental is very low risk, but it's also fairly low reward unless you're investing for a long-term play. You know, turnkey means everything's done. There's not even light value add or anything along those lines. So if I'm just buying a 10-unit building, it's fully renovated, fully leased up, and I just sit on it, you're not going to have a lot of cash flow because you're going to have to pay like a retail price for it. But you can get fixed rate financing, which is low risk. You don't have to worry about the lease up risk. You don't have to worry about the construction risk. You don't have to worry about those things. You buy it, have very predictable income, very predictable expenses with the intent of holding it long term, right? And you buy it, you bump rents every year for the next 20 years, you pay down the loan over the next 20, 25, 30 years, and you find yourself a very low headache, very low brain damage for operating something like that.
And a similar reward at the end of the day than the other ones that we've talked about?
Depends on what your short-term versus long-term goals are. I guess, I went over ground-up construction and I went over the heavy value add in more of like a 5-year mentality when I was looking at those. So on this one, over the course of 5 years, the upside isn't there as much unless you're buying in a market that that is appreciating, which means population's moving there. And so if you look at it from that perspective and you know that you can bump rents over the course of the next 5 years, it's a very low risk and has some upside potential. So I'm going to go with, I will say some of the single family stuff that I bought has done really well, but they were also value adds. They've gone up in value, both from appreciation and from the value add component. From a turnkey perspective, I don't know. I just don't want any more headaches, so I'm going to put it at number 2, just in case.
Okay, so we've got 2, 3, and 5 on the board. Our next one is midterm rental. Risk versus reward, blind rankings. We have the first and fourth spot still available, 2 left.
Yeah, so a midterm rental is like a corporate rental. They come in, they rent it for 6 months or something less than 12 months, more than 30 days. That's a midterm rental. Typically in those scenarios, you have probably a little bit nicer of a unit. It's probably fully furnished. You're getting a premium on rents, but you also have more turnover. The number one expense in owning rental real estate is turnover. And so if you can't...
You have your turnover is built in. Like you're definitely going to have turnover because by nature of what you're renting.
Like a short-term rental. But does the premium on rent exceed whatever the cost of turnovers is? Where, if you have an annual renter in place and that turns over every 18 months on average, you know what your vacancy rate's going to be. On a midterm rental, it's going to be more of a vacancy rate, but you're getting a premium in rent. And so if it turns over 3 times in 18 months, does that premium in rent offset the turnover costs or any sort of vacancy that you have? So that's the question. If I had to place it somewhere, because I only have those left, I'd place it at number 4. But otherwise, I'd probably place it at number 2 and bump the other ones all down.
Okay, so
I like midterm rentals.
We'll recap at the end here. So the last one on the list is triple net lease. These are all aggregated from ChatGPT if you care to play along at home, but just getting out ahead of any sort of criticism I may receive for the numbers.
I was hoping, I was expecting that you'd have some sort of a light value add in there, and that would be my number 1. Something that's mostly stabilized at 80 to 90% occupancy, but the below market rents, there's inefficiencies in operations, but it's built. It's got easy financing that you can put in place, fixed rate financing you put in place, some light touches, light attention. That, to me, for what I'm looking for right now, is like the ideal opportunity.
Well, you can't assume appreciation, and you can't assume that you're going to know what's coming up on these blind rankings. So that's not an option.
So that I thought you'd come up with better options. So
you thought I would come up with the options that you wanted.
Yeah.
Okay. So.
All right. So I would say,
triple net.
Obviously it's got to sit in number 1, but it's not because that's what's left. But I wouldn't have put it there. Triple net's awesome because it's very low headache, very low risk. Usually there's corporate guarantee on the lease, so if they go out of business, they're still paying rent for the rest of the
triple net
term.
lease. Let's just define it right out.
Triple net lease is typically happens with a retail space, and you rent it, and they cover everything. Right, the tenant covers all the maintenance, all the taxes, all the insurance, and you're only responsible for essentially giving them the box, and they then run their business for the next 10 years or 20 years even. So the beauty of that is very low turnover. They have the risk on taxes increasing. They have the risk on insurance increasing. They have a corporate guarantee. The only downside is the upside of it, right? In 5 years, you're not going to get rich off of a triple net. If you're investing for the long term and you're going to hold it for 20 years, definitely, right? Like there's definitely some opportunities there. So triple net would be up because the risk is so low, but when it goes vacant, it does sit for a very long time typically, unless you're a rock star getting things leased back out. So I would say, it's got to sit in number 1 because that's the only one that's left.
Okay, so let's maybe give you an opportunity to reorder these. So ground up development, is that staying 5?
Staying 5.
Okay. Heavy value add, you had it 3.
4.
You're moving that to 4.
Yep.
Okay. Turnkey rental. Based on this, I think what did you have it at 2?
Yeah, this is a single family. This is a residential rental. It's either 2 or 3. along with triple net would be 2 or 3, and then I'd put midterm rental as number 1.
Number 1 based on what we have here.
Yeah, based on what's here.
So even though you knew what was coming, even though we gave you a chance to reorder it, it really does depend on your risk tolerance in terms of
risk tolerance and your ability to reposition something, right? Somebody else who's like absolutely loves construction and is in that every single day, they might love ground up new construction because they're very familiar. It's a lot of moving parts though. There's a lot of moving parts in that space. We've done a boatload of heavy value add. It's just for where I am and we've built a lot of equity, right? Created a multiple 8-figure net worth by getting into heavy value add and repositioning these assets. I just don't want to deal with it anymore. There's a lot of risk that goes into it, and so you got to kind of balance that out. A single family turnkey rental that you buy from a turnkey company and then you take it on from there, or even if they handle it, it's very easy, very low risk. But I've seen that also play out poorly by people who are just completely hands off, and they don't pay attention to it. They expect management to handle everything. They don't want to put any more money into it, so then it turns into a pissing match between the seller, the buyer, the management company, and yeah. So I mean, it depends. And then the triple net, pretty clean, pretty easy, pretty like if you can get it occupied, triple net's awesome. Triple net would be, and depending on how long the lease term is, right? If it's a 5-year lease term with an option, but that option puts them back at market rate rent. The issue with triple net is there's no upside until the lease term ends. And so a single family is actually a little bit better than that because if the rents go up, you can just renew their lease next year at 5% more, 10% more as rents start bumping. And so you get that value way faster versus a triple net. You have to wait on it. And as you wait on it, it's like, man, by the time the lease term comes due in 10 years, dude, we're talking about 2015 prices when this lease was signed, and this thing has appreciated so much in value and rents and grown and everything else.
Can't you build in a 5% increase into a 5-year lease though?
Yeah, okay. You could. If that's done, right? In 2015, that probably wasn't done. That was probably a 2% per year bump, and which means it's still dramatically behind what it's worth today. Still, I'd say single family rental number 3, triple net number 2, and then I do short-term rentals. If you can manage it, right? If you can't manage it, probably don't do short-term rentals. Probably do.
Yeah, if somebody leaves and you're flat-footed, you're in big trouble.
Yeah. You need to be able to fill that back up. But generally speaking, it's a nice property in a nice area, and financing is a little bit tougher to come by. If it's like a multifamily, like they don't like to see a lot of short-term leases. If you have more than like 10% of your leases are either short-term or like mid-term or coming due in a certain amount of time, lenders don't love to see that. So just being aware of that and navigating that space. But I think risk-reward, which is what this is, you can get a lot of upside for fairly low risk, right? A nice property, a nice area will lease out at a worst-case scenario into a long-term lease, right? Best case scenario, you can either short-term rent it or mid-term rent it and get a premium, but it doesn't sit vacant for a long time. So that would be number 1.
Okay, figure out what you're good at, what your risk tolerance is, and sort of dive into the asset classes here as we do another blind rankings. Tim had one that he hoped that he would see in the 5, didn't happen. Maybe there's one that you thought you would see in the 5, or one that you're really good at that you think should go in a certain spot. Go ahead and leave that comment right below this video. We thank you for subscribing, watching the videos, sharing all the videos, and we'll have another blind rankings coming up soon. Until then,
be your best.